All right, now we got sound on my microphone. Good morning. All right. Welcome to FX Street. Trade non-farm payrolls live. 196. Trade non-farm payrolls live. 196. Hey, that's pretty interesting, huh? I mean, that's pretty serious, huh? 196 months that we've been doing this. That's pretty cool. Have you been doing anything else for 196 months in a row? Hopefully not a dead-end job somewhere, huh? Wouldn't that be terrible? $196. That is 16 and a half years that we've been doing this webinar. 16 and a half years. FX Street coming together with FX Bootcamp. I think that's really cool. So thank you for being here, everybody. And thank you to FX Street for being wonderful hosts all these years, decades even. My name is Wayne McDonell. I'll be your guide on this journey we call Forex today. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Today we have non-farm payrolls. I can go over what that is, and I'd like to do some work today as a means of teaching you how to think about Forex, both technically and fundamentally. And I thought we could go through and look at the background facts leading up to the headline number. What will the non-farm payrolls headline number be? What will the unemployment rate be? And we'll take a look at that. We'll also do some technical analysis just to make sure we're all on the same page. I consider the actual headline number when it comes out in 1 hour to be simply a scalping opportunity. I want you to understand that news is different from fundamentals. You know you're talking to an amateur when they confuse news with fundamentals. News is news. So when the news comes out, there is an event-driven strategy that centers around the volatility. And that's when scalping comes in. But whatever happens today will not likely change anything fundamentally. And that's not what market participants, institutional market participants, are not looking really at the headline number. We're well past that. So this is just a vol opportunity, a vol op. So make sure you ask questions, and I will do my best to go through this process with you. If you don't know me, my name is Wayne McDonell. I've been doing this for a while. Before Forex, I was a successful high-tech entrepreneur in the Silicon Valley and venture capitalist. I once sat on a board of directors with George Soros and ran a nonprofit organization of about 3,000 people in the United States. Before that, I actually worked, gee whiz. Before that, I actually worked at a place called NASA. That's the old space company. Remember them? Yeah, I worked at NASA. I was training to be an astronaut. An astronaut. Let me get some coffee down my throat. It turns out I'm diabetic, and they don't let diabetics into space for some reason. Unless you got $1 billion, you can do whatever you want. Pretty cool job. Almost as cool as being a Forex trader. So let me know how I can help. My educational background is in macroeconomics. I have a bachelor's degree in macroeconomics from a small private institution called Harvard University. Pretty cool. Did have a master's degree in financial management. Again, from Harvard. I studied cryptocurrencies under Gary Gensler, who now runs the SEC and regulates cryptocurrencies. He was my professor at MIT in the cryptocurrency program. I also studied algorithmic programming at a little institution outside the United States called Oxford, and completed the algorithmic trading program. And holy smokes, are those guys smart. If you can get your kids into Oxford, you should. So anyways, I know a little bit. Been doing this for 20 years. Know a little bit. I would venture to say the most important learning lessons I've ever had in this thing we call Forex are the mistakes. And I've made plenty of mistakes, so I can share a lot of things. So I'll let you ask questions. And I look at myself as a servant here today. And so let me know how I can serve you. I've been doing webinars, like I said, with FXstreet for pretty close to 20 years now. I think it's 18 years. This one particular webinar is a series of webinars that has been going on for 16 and a half years, but I've been working with them longer. So it gives you a sense of how long I've been trading Forex. So that's cool. So you can imagine there's hundreds of videos on FXstreet related with my work. If you go to YouTube, there is approximately 6,000 videos on YouTube associated with my work. So again, you can go to youtube.com/FX Bootcamp. You can go to youtube.com/FXstreet. You can go to youtube.com/TradersWave, for example. Cool. And those are all free. I wrote a book back in the day. You could buy it. It's on Amazon. I love it when people ask me, where can I get your book? Is there another place on the planet you can get a book besides Amazon? Like, it's the only bookstore in the world, right? Yeah, Amazon. It's called Strategic and Tactical Forex Trading. You don't have to buy it. It'll cost you money. But I did write it, and I believe it's honest. And 1/3 of the book is on how to plan your trades properly using journaling. Yeah, 1/3 of the book is on journaling. It's that important if you do it right. Almost nobody journals, and those that journal don't do it right. So I think it's important. So yeah, check it out. Lastly, if you need a foreign exchange broker, I'd like you to try Traders Way. I consider them an ethical foreign exchange broker. They have a business model based on ethics. They see themselves, in my humble opinion, as developing a symbiotic relationship with you. If they're going to succeed, they need you to succeed. I know this sounds like an advertisement, and it is an advertisement. But think of it. They're not advertising that they're the cheapest. They're not advertising to convince you to open up an account and then blow it up and move on.com. Many foreign exchange brokers will trade against you. Do you remember when the Swiss National Bank pulled the plug on the euro and the biggest brokers on the planet for retail Forex traders went out of business overnight? Why? Why did these giant big brokers like Alpari go out of business overnight? Is it possible they didn't enter all those trades into the interbanking system? Is it possible those giant brokers were trading against their own clients, hoping those clients would lose money? Was that the basis of their business model? Did they treat their clients like they were stupid? They're like, these idiots can't make a trade, so we'll trade against them because 95% of them are going to lose. We'll B-book everybody. Well, that's kind of what it looked like. And then Traders Way, a boutique foreign exchange brokerage firm, was perfectly fine. They were fine. I even called them. Actually, I didn't call them. I emailed them. And they're like, no, we're fine. And I'm like, other brokers are going out of business. And they're like, well, we executed all the trades, so that's on the clients. If they took that risk, that's on the clients. But as far as a brokerage firm, we're totally fine. We executed the trades as asked. And I'm like, oh my God, that's so awesome. So, a business model based on ethics. Try tradersway.com. Maybe open up a demo account and see if they will earn your loyalty and respect. No, Sean, that was probably 9 years ago. So the answer to that is no. But yeah, that would have been interesting, right? Oh, well, look, hey, we got a good question right off the bat. Thank you. This is probably the most important question ever. So let's get rid of this and let's go over to here and then I'll answer that. What is non-farm payrolls and why is it important? Well, let me start with the second one. Why is it important? It's a barometer to the health of the United States economy. One of the most important aspects of the economy is jobs. When lots of people have jobs, lots of people have money. When lots of people have money, they consume. Consumption is important. And the more money you think you're going to have in the future, the more you consume. That consumption creates demand. And demand is good. Therefore, more people need jobs to supply that demand, and the economy is healthy. It's particularly important in the United States because 70% of the U.S. economy is the U.S. economy, meaning its own consumers, not foreigners. So you want people to have jobs because they work, the work is productive, so you have growth, and people have money, which is productive, and then there's growth. Okay? So it's an important barometer. If we're losing jobs, something is probably wrong. So now going to what is it? Non-farm payrolls is the jobs report, but it's actually two things. There really isn't a report called non-farm payrolls. There's an establishment survey, which is a survey of businesses and their payrolls. So it literally looks at the paycheck stubs. And then there's the household survey, which the Bureau of Labor Statistics in the United States, a government agency, contacts, I think it's 6,000 people, households, and they survey them. Hey, what's up? This is the government, yo. You got a job? Yeah, I got a job. And they say, okay, has a job. Now, they don't really care beyond that because if the person said, yeah, well, I have a job, but I have a master's degree in quantum physics and molecular chemistry and French existentialism, French existentialist poetry. I have 3 master's degrees. But I work at Applebee's as a waitress and I Uber. That's a lot of critical information. Underemployed, has one part-time job, and the other one is, I guess you're listed kind of as a contractor, so it's not even a part-time job. You get paid when you Uber, and you don't get paid when you don't Uber. And the government says, oh, so that's a yes, you have a job. Okay. Now, maybe that person gets counted again in the payroll stuff. Jacob says it's not a bad gig though. You make a lot more money trading Forex than Ubering. So it's not a bad gig, but very few Uber drivers become millionaires. So depends. You might be wasting your time making $200 a day driving Uber, right? I don't know. You put it into context, right? So anywho, so that's what these reports are going to come out. So imagine the government talked to 6,000 households, and then from that extrapolated how the economy of 360 million people are doing. You're like, well, that's not a really big sample size. Well, look, they've only had 4 days to come out with the number. Think of that. We're all trading a number, and the government has 4 days to come up with the number. And they only talked to a few thousand people. And you're like, there's no way that that's accurate. I know, that's why they produce the revisions, because what happens is after the headline number comes out, they spend another month making more calls, doing more research, and they come up with a better number. So really, you should be trading the revision number or adding the revised number into your model. The headline, it's a big number, it's a small number, it creates volatility, people go ape crazy. But really, if you do a little bit of research, what you'll find is the vast majority of market participants during non-farm payrolls, when the number comes out, is retail Forex traders. So it goes up, it goes down, it goes sideways, everybody loses money, and nothing actually happened. And then maybe at the end of the day, institutional money comes back into the market, certainly if not by Friday afternoon, certainly by Monday morning. Okay. Yeah, DK, haven't seen you in, 12 hours? Yeah. Thanks for coming back. Yeah. So anyway, so that's what it is. And the headline number might give us a sense of how healthy the economy is. So what is the question being asked? Are we in recession? Are we going to go in recession? When will the Fed stop raising interest rates? What is the terminal rate? These are all very good questions. So now you take this headline number, and very often people will say, oh, that's a good number. Well, remember, you have to put the number into context. The context of what? The question's being asked by market participants. Okay? The question is, what's the terminal rate and how fast are we going to get there? So here's the interesting thing today. A big number is good because it means the United States is still adding jobs and maybe the unemployment rate falls even further. But that would be bad in the context of the question being asked. The question again is, what is the terminal rate for the Federal Reserve and its policy of raising interest rates? And so what they're looking at, and maybe we'll even look at it, we'll look at what the Fed, let me ask you, let's stop right here for a second. What is the Fed worried about most right now? What's the prime concern for the Federal Reserve right now? The one thing they're looking at most. And how do you know that? How do you know let's talk about facts. Let's talk about facts, baby. Let's talk about you and me. Okay? My colleagues and I are committed to bringing inflation back down. Okay? And they're moving expeditiously. This is the press conference after the Fed meeting, July 27th. They have the tools to resolve it and restore price stability. Okay? They want to get it down to 2%, which is a way for them to tell you what the neutral rate is. From the standpoint of congressional mandate to promote maximum employment and price stability, that's the dual mandate, the current picture is plain to see. The labor market is extremely tight, and inflation is too high, is much too high. Wait, we're talking about inflation, but isn't he saying that this is the cause? Up here he says they're worried about inflation. But here he says the labor market is extremely tight and inflation is too high. Cause and effect is kind of what he's saying, right? Okay, so why would he say that? Recent indicators of spending and production have softened. That's not good. Growth in consumer spending has slowed significantly. That's not good. In part reflecting real disposable income, right? Lower real disposable income and tighter financial conditions. That's not good. Activity in the housing sector has weakened. That's not good. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. All of this is bad. So what does he say here? We're looking at all of that, but despite all of that, they jacked up interest rates by 0.75%. Why? The labor market is extremely tight, and therefore inflation is much too high. So what are they watching? So despite all this bad news, the labor market has remained extremely tight with the unemployment rate near 50-year low, vacancies at historical highs, and wage growth elevated. And an average NFP of 375. I'm going to break this down today, and we'll take a look at that. So what he's saying is there's a connection between this, and here's the interesting thing. Wage growth is elevated. Okay? Well, if you do some research, and I'll leave it to you, now that you know this is important because you actually attended the FOMC meeting and you actually read what they said, like they're giving you the answers to the test. I mean, come on. You don't read this? Then what is it that you do? Okay? But anyways, wage growth is elevated. Well, if you do a little research, it was 5% wage growth. And it's now 2.5, which is interesting. So this is changing. But we're also looking at the unemployment rate. So now, and this is the average. So I think this is falling, which continues to lower household income, which would be deflationary, which would indicate that inflation could start coming down. But the other thing that's clear that the Fed is still watching, I mean, they actually mentioned the average NFP and the unemployment rate. So now, why don't we do a little bit of research to come up with an opinion based on facts, not what some guy said on Bloomberg television. You develop your own facts and say, well, will the unemployment rate, will unemployment rate fall today? And what will the headline non-farm payrolls number be? So let's do like the ADP report, FXstreet. Let's see if I can find it this way. Is it going to be there? FXstreet. Cool. Oh, stupid Google. Okay. Came out. Wait, that's not the right one, is it? Thursday, June 2nd. Where's the July number? Anywho, yeah, there's no July number. Maybe we're on a old part of the site. Anyways, what you want to do is look at that number. Is it in here? Yeah, I'm just trying to see, is that an old number or not? Try reloading it. Anywho, we want to look at sort of the trend here. Okay. It's all over the place a bit. And you look at what direction NFP or the ADP report is maybe going. There's no direct correlation. Okay? There's no direct correlation, but it is a way to look at what small and medium-sized businesses are doing on their payrolls. Okay? Another thing you would want to look at is ISM. Okay, you look at the service report. Okay, and jobs are coming down in the employment, but month over month are up. Okay, so there's a downtrend. People that are participating in the ISM surveys, those companies have seriously cut back on hiring, but is actually up month over month. In a downtrend, there's an up move. That's just for services. Then you look at the manufacturing, which is only 20% of the economy. It's very, very similar. Employment is contracting, is actually quite bad right now, but is up month over month. Okay? You can look at Challenger Christmas in gray. I always have to go to the bottom to find it. Press. Okay. Okay, and this is reporting 26,000 job cuts. Then you do the Fred, which is a St. Louis Fed, okay, and you do weekly jobless claims, you run it right from there. And you narrow this down. By the way, in my macroeconomics course at FX Bootcamp, I teach you how to use the Fred so you can gather your own data. Okay? Going from here, let's zoom in even more. Oh, it won't let me zoom in anymore. That's max. Oh, no, there we go. You can see there's a steady uptrend of people applying. I can go back even a little bit less than that. There we go. There's a significant uptrend in the amount of people applying for unemployment insurance. These are people losing jobs. Challenger and Christmas and Gray measures layoffs. This would be like layoffs and any individual that lost their job. Layoffs are when lots of people from one company are all laid off or fired at the same time, let go at the same time. This just measures in the individuals that had work, lost work, and are asking for unemployment benefits. So this is clearly an uptrend. But if you look at ISM, okay, this uptrend means people losing jobs. ISM services and manufacturing, which is a broad survey of many thousands of businesses, show a different sign that no, in fact, those companies are hiring and have hired. So we have this being a negative number for jobs, and then a couple other reports are showing a positive number, perhaps offsetting each other. I don't know if that's going to give us the right number. Private, that's just private payrolls. Anyways, it'll give us a little glance. Okay? This might not be the actual right thing, but it's close. Let's say we're just playing around with this. This doesn't look like a downtrend, does it? So this is job growth. Okay? So we're looking at the trend of people losing jobs, but is it impacting things? How about unemployment rate? Unemployment rate. Okay, down, obviously. Unemployment rate. I think there's another one in here. Same kind of thing. Now, we're going all the way back to 1930. Why don't we look a little closer? Hey, that didn't update properly, did it? Let's redo this one. Is it going today? No, it's only doing up to that point. Oh, so that's not even the right. I don't know why it stops there. That's interesting. 1942. Anyways, what we saw before. Okay, we were non-cyclical. I'll try to get that. Okay, anyways, what I'm trying to get down to is the numbers haven't changed direction radically. So what we saw is the Fed is super interested is in inflation, and they're using not the CPI, but they're really looking at wage growth and the number of jobs being added or lost, And I think what's going to happen based on this quick research is that there are some people losing some jobs. Who's losing jobs? Not people that are part of the ISM survey. Well, that means they're not medium and large size businesses that are part of the supply chain. So it's one way of looking at it where there's two worlds. See, in Japan, they say there's good inflation and then there's bad inflation. Bad inflation is related to the lack of supply chain. So like high oil prices is bad, but good inflation is a result of people having money and spending, which is demand. That's consumption. Is it possible that there's good unemployment and bad unemployment? Well, one way to look at things like if ISM shows that jobs are up, but weekly jobless claims shows that jobs are down, which one's right? Well, they're both correct, but somebody's losing jobs in one section and one are adding jobs in another. LVMH, Louis Vuitton, Moet Chandon, Hennessy, these are very high-end brands, very, very expensive things. Okay? Demand, so they own, for example, Dom Perignon, the fancy champagne. Their sales and demand are up 15% year over year. Walmart is struggling. Sales are down, inventories are up. And I think that's what we're starting to see in like weekly jobless claims. Okay. In some neighborhoods, less people are eating out, for example, maybe. But Louis Vuitton is still making money hand over fist. Dom Perignon are still selling $200 bottles of champagne with no problem. In fact, Dom Perignon raised their prices from I think it was more like $220 to $280 per bottle, and they're selling them faster than they did a year ago. So rich people still have a bunch of money. In fact, they still have their Grandpa Joe money that they got for Christmas. That stimulus money, rich people haven't spent. They didn't need it, and they still got it. Okay? So some people are in trouble and some people are not. So we're going through kind of an interesting pause. But let's get down to brass tacks. Okay? If weekly jobless claims, okay, say, let's label this NFP. If you looked at the trend in weekly jobless claims, that's going up, so that would suggest NFP down month over month. Okay? But then, if you look at ISM, remember this is a survey of thousands of businesses across the United States, and you read the numbers, yes, there's a slowdown, but month over month, it would suggest non-farm payrolls will be up. So let's just say they generally offset each other. And we've seen that inflation in the United States is still high, and that the trend in unemployment, employment we'll just call it, not unemployment, we'll call it employment, is not, I'll say it differently, right? Is not down. So here's what I would look at this model and interpret. Okay. Last month, I think we had 375K, and I think the number is 260K, right? Okay. I would think we're going to be looking at 375K because ISM will offset weekly jobless claims. 250, 260, don't matter. However, that's not quite right because a missing piece of information now is the Challenger Christmas and Gray report of negative 26. So we'll just say negative 25. So we refine this a little bit, and the number is 350, which means the unemployment rate stays the same. You guys follow? Which means nothing's actually changed. The unemployment rate won't change. The number of jobs added month over month is about the same, but significantly better than this. So another way of looking at it is experts come up with 260, and they're probably smarter, and they have better tools and all that stuff. But a quick glance of trends in some of these things and some of the reports, well, I'm not sure how they got there. Doesn't really matter. You know what matters is how the market reacts to it. So let's do some behavioral finance. Let's say I'm right. Let's just pick on me for example. Let's just say I'm right. Not that I am. I have no idea. And I don't even trust their math. So they can come out with some crazy number. So this is me being logical in an illogical market. But whatever. So let's say it comes out 350K. That means the Fed is unsuccessful. They jacked up interest rates dramatically, and it has not had the impact necessary. So the Fed raises more. More than what? More than what's been priced in. Remember, the response to the number by the market is what's important. I don't care what the number is. How they respond to it matters. So this is really good. We added 350,000 jobs, and we thought there'd be 100,000 people would not have those jobs. So that's actually a very good thing, which then pushes wages up. Well, wage growth has dropped, so that's a good sign. But nonetheless, the job market is still ripper hot, and the Fed says because of the red hot job market, we have inflation. And we want to kill inflation. So they have to continue more than what's been priced in. So a good number is bad according to behavioral finance analysis. And then so how do we measure the actual opinion? Well, we can do price action. Obviously, when it comes out, there'll be a scalping opportunity. But that's really neither here nor there. What we want to watch is the change. Okay? Now, yesterday, this was 66%. Today, it's 59%. What does that mean? People think NFP is going to be big. Well, at least more people today thinks NFP is going to be bigger than expected than yesterday. Cool. But that's not actually what I'm interested in. I'm interested in 1 year from now and the terminal rate And so I'm studying whether people move their opinions this way or if people move their opinions that way. If it's to the right, USD up. If it's to the left of the bell curve, because it's just a bell curve, right? So I'm watching the tails specifically, then USD down. Okay, so it's a bell curve, and I'm interested in the kurtosis of the normal distribution. Golly, that sounds smart. Yeah. So we'll watch this because this is banks negotiating contracts, loans to each other, based on what they expect the interest rate to be 1 year from now. And this is not opinion like a survey. This is an opinion expressed in hundreds of billions of dollars of actual deals negotiated and priced in. That's the price. You can reverse engineer the price to figure out the interest rate that they calculated. And so 1 year from now, on July 26, 2023, will interest rates be 3, 3.5, or 4? Well, only 3.7% of all those deals have priced in 4, but maybe tomorrow this goes to 9. And right now, 3.75, only 15% of the deals are at that level, but what if that goes to 23? And meanwhile, these are shifting down to 25 and 20. Well, that would be a right shift. Those are new deals being priced in, and the dollar would go up. Because you'd need more dollars to make that happen. My God. Isn't that awesome? How pretty. So let's talk about the scalp. Oh my God. I don't know if I can even. Let's do it this way. Okay. Let's find the scalp. Okay. So the news is going to come out and there's going to be a pop. Which way? I don't care. But I would assume a big number brings euro dollar down. A low number pushes the euro dollar up. A big number pushes the stock market down. A low number pushes the stock market up. I can carry this out for pretty much every asset class there is. So in this example, there's a reaction on a 1 minute chart. This is a 1 minute chart. If you get a red candle, you're a bear. No. If you're a red candle, you're a bull. Bulls buy low, bro. Okay? So what you want to do is pay attention to the top of the range, and you want to buy a dip. You probably want to look left a little bit. Oops. Okay? And I typically would look here for price action, but I'm also looking just at the Fibonacci. I don't really care. In this case, I wanted it to bounce, like I said here, but it didn't. So this is not a perfect example, but I want you to look at the fact that you're thinking up, and what do you get? Red candle, but it holds. The next one holds. The next one holds. The next one holds. So you have 2, 3, 4 minutes of no lower low. You want to take it north, son. Okay, remember these are 1 minute, high volatility event driven strategy. If you take it, honestly, in 4 or 5 or 6 minutes, you should already be profitable. And so if you entered around here, or if you entered around here, at some point you want to move your stop closer. You probably won't get it all the way to break even, but if this is your entry, maybe this is your stop. So you move your stop from below here to about here, and you're basically break even. And the idea is when you get here, it's either going to collapse on you or it's going to make a higher high. So you want to be hero or zero when you get to that point. Here's the moment of truth. Are you going to make money? Are we not? Are you going to make money? Are we not? Are you going to make money? Boom! And he made money. That's it. I wrote this strategy down at FXstreet many years ago. There's also a counter trend. And a counter trend suggests you find the high and the low of the current range. And if it spikes high, when you get to the top of the range, there's going to be a lot of profit taking from the scalpers. Okay? And so then you would counter trend that. So let's get to euro dollar. Hang on, why is this one set up so weird? I usually don't sit on this one, but okay. Cool. So I'm going to lock in 50 pips profit. Isn't that nice? I just made 50 pips. 528. So I was right, significantly higher than expected. And I'm right in the sense that the US dollar got strong. You're welcome. Bravo! Bravissimo! Right? Cool. So, how is it that I'm already in this trade? I did all this analysis yesterday in my swing trading group. We already knew this. How many people would have liked to have known this yesterday? I'm telling you, I covered the whole speech yesterday in the swing trading group. And we already did this. And we already knew the numbers were going to be big. Not from opinion or hope, because we did research and quantitative analysis, actually, on this data. I'm going to lock in a few more. Nah, I'll leave it at 50. We'll see. Let's go for a little more. Let's add some colors to this chart. Let's do a bearish confluence. And you'll look at it and you're like, oh my God, it was such an obvious sell if you were set that way. But my profit target is actually 101.49. That's the aggressive one. Let me actually open up my indicator. We're probably hitting the conservative target, so I could take profit here. Oh, am I missing the midpoint? Oh, that is the midpoint. Oh, okay. So, cool. So, okay, that's the conservative target is here. So now I got a limit order. So I'll either make 50 or more. But you can see here, based on current price action, if you will, the conservative target is here and the aggressive target is there. You see that? Bearish, profit, target, conservative. Now that's just for a pissy little scalp non-farm payrolls trade. Okay. Do you go over cryptos and metals? Yeah. You usually got to ask for the crypto. I usually do gold, but I usually don't do silver. But if you ask, I could do it. I mean, you're the boss. Okay. But let's take a look at a bigger point of view. Okay. Euro dollar's been going up quite a bit for quite some time. And I'm a bear. Euro dollar's been going up. I'm a bear. I really don't care at all if it's going up. Irrelevant to me. So what I'm looking at is the much bigger picture. And I'll tell you what my technical target is. Okay. 97. Damas, what? Yeah. So we'll see if we can get there. Obviously not today. But, carrying out sort of price action, I'd expect next week and next month to kind of look like that. Okay. So J-Man wants to know about gold. I can tell you, based on seasonality, gold typically goes up this time of year, but based on market, let's say global macroeconomic conditions, in particular the central banking policy of the United States, which manages the value of the reserve currency for the entire world, I would expect next year to be a good year for gold, not this year. Okay, I'm going to lock in some more profit, just a little bit more. So that's 60 pips. Cool. Okay, so anyways, I wouldn't be interested in gold right now if I were me. Even if it was going up, I would just be, day trading it, but it wouldn't be a real opportunity to own the asset. There'd be better opportunities. Let's take a look around the world, see how everybody else is doing. Okay. This is another trade plan that we already have done. Okay. So the trade plan right now that FX Bootcampers have done. By the way, you're invited to join FXBootcamp.com. It's $88 a year for 65 hours of training. Okay. Anyways, what we came up with is this. Okay. Selling around 70, targeting 68. And you're like, Wayne, that's only 200 pips. Oh, I know, son. But actually, that's the short-term move. This is part of a bigger play. Again, down into here, then up, and then down, and then up, and then down, and then up, and then down. Okay? And the target is 66.50. Wow, sorry, 0.6650. So again, only 350, but that would be a typical trade that we set up in the swing trading group where you're trying to get short and, a target of 333 is standard operating procedure. If there's not 333 in it, it's probably not a decent swing trade. Gold investor says, wow, the Dow dropped like a ton of bricks or like a rock. Oh, I know. It makes sense. That's what I explained before the number came out. I'm hedged, by the way. So that's that. Okay, taking a look at, do you want to do Piggy? I guess we can do Piggy. Let's drop into a 4-hour. Okay, this is the same. Okay, current target is around here. So we have the up, there should be a down, there should be an up, and then there should be a more significant down is what I would think. J-Man says bottoming. Oh, I don't know about that. There's so many other risk variables that might happen that would be the catalyst for that. So it's more like my analysis of economics would tell me the rally we've had in the stock market is more of a dead cat bounce, bear market rally, and it's quite premature. It might be right, but not enough to go all in. Okay. Okay. So, once again, I'm not talking about opinions. I have a bias. What's the difference between an opinion and a bias? My bias is set from the interpretation of analyzing economic data. So it's not an opinion. Okay? There's a difference, right? I'm not interested in opinion. Yeah. So it's cool. All I'm suggesting is you can do research that can be helpful. So it looks like I got 60 pips out of that trade. It popped me out. Cool. I can get back in later. Cool. 60 pips. It might have been like 66 maybe, but cool. Cool. That's nice, right? Take a look at how the world is responding to this. No, I probably won't do Ethereum. Okay, let's do, so we got yen coming down. We have euro going up. Pound is trying to stabilize. CAD and everything. So a lot of things are quite neutral. So let's get a bigger point of view, a longer term point of view. Okay. Yen actually, over the medium term, losing value, okay, shows money flowing out of Japan in the absence of yield curve control. Okay. Dollar stabilizing after its short-term weakness. So as this was falling, I said, wait, you can still be a bull. You just wouldn't be buying. You gotta wait for the catalyst. You gotta wait for the change in trend. So maybe that's what we have had now. Pound weak, but at support. And I'm looking for a lower high, lower low now. That would be great for pound. Okay. And Aussie, Kiwi still coming off. So the commodities are still coming off. Obviously, oil down. Obviously, other commodities are down. And so that's negatively impacting them for now. I think that'll change around the third week of August, but we'll see. Let's do gold, oil, and Bitcoin. Okay. Going out to the hourly chart, you can see this has been bearish for quite some time. And maybe we hold in here. We'll see. We'll see, huh? We'll see. But what I'm most interested in is I'm actually a bull on WTI, but I can't be a bull until we get higher highs and higher lows. So I watch it fall and I'm like, oh, that's interesting. So back some of this out. Okay. So we got to get back into here and then back above that and all that kind of stuff. Yeah, Johnny, it could be. It could be. So right now we have a trap between a top and a bottom. You could play it this way today. Okay. So you can count this as like a range. You can count it from the top of this as well. So you can say, Wayne, why would you do it there? Well, you don't have to do it there. I don't care where you do it. You just make a decision. Okay. And so what you could do today is if it breaks low, you end up selling the retest. If it breaks high, you end up buying the retest. So you can change the template if you prefer. By the way, these colors are actually just the different trading sessions. Okay. So, for example, what I just talked about here is you see how we're in this this purplish gray zone, like we are now. So that was New York yesterday. So New York opened here and went up, and then it came down. So I'm just tracking the open. So you could put this as a floor and this as a ceiling, and like I said, okay. If you think it's going to go up, you could wait and catch a pullback. Okay, or you could wait and catch the break. You see the break? So you're just waiting for the breakout. It's just a little breakout trade, and it breaks to the downside, so you sell the retest, and now you're done. So you sold it at 91.5. And it breaks down and ends the session at 89. What's that worth? That's the equivalent of 250 pips if you were trading euro dollar. Okay, so for a lot size. So if you trade euro dollar mini lots, okay, it's like per mini making $250. Well, hey, that's a pretty good morning, huh? When was the last time you made 250 pips on a euro dollar just in the New York session? Yeah. Oh, by the way, I guess I should plug my training course. Yeah, let me plug my training course. Forgot all about it. Oh, man. I'm enjoying this, by the way. We're having such a good time. Oh, I haven't fixed the timer. Anyways, ignore the timer. I'm doing a training course. The Energy Complex made easy, 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 easy. We're well into this. I've done 7.5 hours of lecture already. So I did a complete overview. I did the history of oil since 1950. Then I added one on geology. Okay. Then we did how to drill for oil. Then I added another one on unconventional. So I just taught people in great detail fracking and tar sands, what you might know as oil sands, but tar sands is closer to the truth. So now people know what a perforating gun is. That's supposed to be. If I say in situ, you know what that means now. Are you mean gravity assisted steam? I'm like, yeah. And you're like, oh yeah, I like that. When I did the infrastructure lecture, people know the difference between a vertical separator and a heater treater. And when I say you got to pull that natty off and send it down a meter line for money, you know what I'm talking about. Because you actually can go through the infrastructure, the actual iron, the actual stuff, the actual equipment on the oil patch. You know all the different components of this rig. You know these storage facilities. You know this is an ancient. Look at it's a separator and heater treaters with storage. And you can look at this and you know what it is. Isn't that cool? So, if you like that, oh, I guess I should give you the link. You should join. It's half price. We're halfway through. It's half price. Cool. So anyways, so that's one little oil strategy that you could be doing today. Okay. Yeah, I honestly doubt there's a training course on oil for traders or investors, really, that is more detailed than this course. I really don't think so. I think to get this level of training, you would have to be in the oil industry. Training on how to work in the oil industry. I don't think there's any trading and investing course that would be even half as much detailed, in my humble opinion. I know that sounds arrogant, but I'm putting a lot of work in it, and it's redonkulous. So anyways. So this is what we did at FX Bootcamp right before the Fed meeting. And I said this: an aggressive Fed, which means hawkish. Okay. Oops. Let's do it this way. The Fed or the market would interpret the aggressive Fed and move gold down. Our crypto already covered that before the news came out. We can come back and take a look in a second, but yeah, dude, it's irrelevant now that the news came out, but we can do this. So anyways, this is before the Fed meeting. And I said, if they're interpreted as being aggressive, this is what gold is going to do. If it's less aggressive, and look at this, guys. I drew this before. I drew this like, a week and a half ago. Okay. And I have it going up. Well, you've heard about the Fed being dovish, right? So in that case, it looks like it was right. Less aggressive Fed. I didn't say dovish Fed. I said less aggressive Fed. And it would go up. But notice right in here, I actually have it coming back down and reversing next week. How did I come up with that? I already came up an opinion about non-farm payrolls 2 weeks ago. So up until NFP and then down after and potentially continuation, maybe even lower. Okay? So that's essentially what? A full 1 week in advance for the up. And then next week, if this comes down and I'm right, then I gave you the actual price action 2 weeks in advance. Huh? That's called fundamental analysis. J-Man says, let's see what happens. Yeah, it's true. I don't know what's going to happen in the future, but I could take logic and I can plan it out. So I drew all of these lines 2 weeks ago. Okay? So it's just quantitative analysis of macroeconomic data. What do you think about that? Ooh la la. Infotech, is it likely to retrace? I think it's likely to do what I told you 2 weeks ago. I have the lines drawn on the chart. I don't know how to answer your question. Thank you, Frankie. Okay, somebody asked about the stock market. Let's take a look at the stock market. I'm going to switch this to MT5, not MT4. Okay. And I have this is my line in the sand. And okay, those are the two numbers that are most important. This is the one that is the current trend is this. Okay. And so I think this is a critical juncture. I think we're at 4,200 because of, right before NFP, because of NFP. And there's logic and reason and rationale that this might go all the way back down to 36. A slow and sustained downtrend. Now, let me tell you something. In early January, for FX Bootcamp members, I planned the entire year in advance. Okay? And what we talked about this time of year, okay, is a slow and steady kind of slow decline. Okay. Now you're going to say, Wayne, well, that's not quite accurate. It's true. There's a lot of variables going in, but at least I could explain how I got there. I can tell you that every single member of FX Bootcamp knew I was ready for the stock market to come down starting in January. In fact, for 3 or 4 or 5 months, I saved money to buy in the 3rd week of January, the 3rd week of February, the 3rd week of March. I'm guessing that's kind of in there. Okay. I bought a little bit in here. I bought a little bit in here. And then I hedged. So I'll use yellow as a hedge. I hedged here. Okay. Most importantly, I described what I was going to do before I did it 2, 3, and even 4 months in advance. Cool. So in that presentation in January, okay, obviously we talk about this. Okay. This was okay, okay, this down was not as expected to be that dramatic. Then this up was normal. Okay, this is the sort of a June in here. And then July is typically a stop trading scenario. And then, so we'll see if this farts around here. And I think we could do this, and then this, and then this, going into the end of the year. But one of the things I talked about in January is normally in the 3rd week of August, I start to buy. Okay? And some years it goes up quite a bit. In, let's say, many other years, okay, it goes up, it comes down, and then it goes up. Oops, that's supposed to be a straight line. And that would be typical. So the way I typically go is I buy here, and sometimes I get knocked out, and then I try again here, and then I make money. What I said in January is this will come down, this will go up, this will come down, this will go up, and then it'll come down, and then it'll go up. That this year will not follow seasonality. Okay, we were talking about this in January. What would happen in August, September, October, November, and December. So if it's against seasonality, what am I analyzing to get that point of view of slow and steady down, slow and steady sideways, and then a pop at the end of the year? How could I say that in January? Okay? Because again, I said the summer would be down to sideways, and we'd have a late pop at the end of the year. If that's non-seasonal, if that is atypical, what would allow me to make that call 9 months in advance, 10 months in advance. Oh, thank you, global investor. Yeah. Well, that's an interesting thing, isn't it? Those kinds of speeches are really sort of like what a rich dad tells his rich kids on how to run their life. And poor dads with their poor kids don't have such conversations. And of course, I grew up poor. I didn't even have a dad. Okay? So I never had that conversation. I had to learn it. Codename says you anticipate the Fed. No. Experience and knowledge. No. Fundamental analysis of central banks. No. Okay? The cycle of financial markets due to what? There's a political cycle in the financial markets. Okay? So what I described in January was this down, stabilization, but slowly down to sideways, and then a pop at the end of the year, has to do with the second year of an 8-year political cycle. Not the business cycle, the political cycle and its impact on investment. Okay. Oh, I talked about overvalued companies. Well, that's actually valuation models of why. So that has to do with why the stock market's coming down. So this first move and the second move are two different moves. The first move down are valuations. The second one is recession. Well, recession fears. So the first one is just math. Anybody like math? Anybody like math? Oh, I don't like math. Yeah. Oh, really, Jim? Yeah, that makes sense. I didn't know that, but that makes sense. Hang on. Let me refill my coffee. Let me give me 1 minute. I'll be back and we'll do some math. All right. How's everybody doing? Hey, did you click the thumbs up button? Am I doing an okay job? If I haven't been horrible today, would you please show some respect to FXStreet for hosting us? And click the thumbs up button and let YouTube know that this is quality content and that FXStreet is good people. Thank you. Okay. So Mujib said basic math is okay. So let's do some basic math, okay? I'm going to assume that the valuation of a stock is based on its expected returns. Is that fair? If you think the stock is going to go up, then you would buy it because you think it's going to go up, and then therefore it goes up. Okay, so you have to have some sort of expectations. So simple math. The expected return of a stock is equal to, okay, the risk-free rate of return, the opportunity cost, plus the beta of the market times the expected return for that market, okay, minus the risk-free rate of return. Once again, this is your opportunity cost, right? So you probably have to put that in brackets. Okay. All right. So let's break it down. The expected return of a stock is equal to the risk-free rate of return plus the beta times the expected return for the overall market, which again is the beta, minus the risk-free rate of return having not invested in the market. Wow. Okay. So the risk-free rate of return is, let's say you could use the 10-year T-note. The yield on the 10-year T-note. The beta has to do with how much this stock moves relative to the market. So that's a number you look up in a table because it has to do with the volatility of the stock. So like one stock might have a high beta where, so stock 1, if the S&P 500 goes up 1%, then it might go up 2%. It's a high beta. It moves twice as much as the S&P 500. If it's low beta and the S&P 500 goes up and it only goes up a half, it's a low beta. It has low volatility. It might have a different risk profile. So based on the beta, your expected returns would be impacted. So again, if it was a high beta stock and you think the stock market's going to go up 8%, this stock would likely go up 16%, and then you got to subtract out your opportunity costs of having not taken that risk. So anyway, so you use the 10-year T-note. The beta is something you look at the table, and then you're like, the stock market is impacted. Okay, by what? Probably the yield on the 10-year. So again, you have this as a key variable. And this, the stock market's going to do what the stock market's going to do. Okay? But let's just keep that as a normal variable. We'll just keep that as X, if you will. So the expected return of a stock, if the 10-year T-note yield is going up, think of it this way. Interest rates are going up. And we saw the yield go from less than 1% to 3.5%. So clearly, the Fed funds rate during that time went up too. So we're substituting a risk-free investment, the yield on a risk-free investment guaranteed by the government, is somewhat of an interest rate. It's a yield, but it's like an interest rate. Interest rates went up in the United States. Yields went up. So you insert this variable, okay, as your risk-free opportunity cost minus the risk you're taking, okay? Subtracting that as your return, and you get this number. So as the 10-year T-note goes up, let's simplify it now. As the 10-year T-note goes up, the expected return from whatever stock you're analyzing falls. It's just the math. The higher the risk-free rate of return goes up, the less expected return for that stock is. So that's one model, but you can analyze cash flows. And you can say the present value of a stock, and we're talking about this point here, guys. The present value of a stock is equal to its future cash flow over 1 plus the interest rate, so this would be your Fed funds rate, over the number of years that you're calculating. So again, if you isolate this, and if this goes from, let's say 2% to 4%, as this I goes up, the present value of a stock based on its value of its future cash flows falls. If interest rates go up, right, or this I could be interest rates, this I could be inflation. So if it goes from 2 to 8, then in real terms, the present value of the companies fall. So whichever valuation model you use, right here, the stock market is supposed to go down. That's why when the Fed started talking about jacking up interest rates, I started saving money to buy the stock market as it fell. And by the way, in, let's say, October of 21, I said the U.S. stock market would fall 10 to 20% in January. Can anybody confirm that? The stock market was red hot in September and October. And then shit hit the fan in November, pardon my French. Okay? And now this one, this downward move, that's the recession move. So the Fed started raising interest rates, jacked up interest rates in this period, and people are like, oh my God, the Fed's going to cause a recession. Not just a stock market crash, but people are going to lose jobs. Okay? And I think we're probably ready for this move. Now, how do I get to that conclusion? Well, this fell, then went up, then this fell, then went up, then this fell, then went up, and yeah. Now, if you read the chart properly, okay, this is what? A 618? This is what? A 382? This is what? 100%. So you'll probably get something more like this. Okay? But remember, I said steady down, sideways through summer, and all the way through to the middle of the fourth quarter, and then a pop at the end. So that's what I already said. In January, I have the recording. Huh. So anyways, there's math. Okay. What do you think of that? Interesting, huh? So the current trend in the S&P 500 is up because trend analysis will only get you like this current move, right? But the interesting thing is when the price action changes direction. Codeman says, hey, when they're talking about, so he's in Poland, it's got the zloty, rates up significantly, yields up. Yeah. Well, that's what happens, is that your opportunity cost is so great for taking risk compared to taking no risk. So for example, if you just put your money in a bank and you earned, 8% a year, you're like, well, why would I put money in the stock market if the 50-year average return in the stock market is 8%? But that's risky. If you could just get 8% by keeping it in the bank, why not do that? The problem is then you can't afford to spend the money, because you're like, well, not only if I take money out of my bank account to buy a television, not only do I convert the cash into the television. So let's say the TV costs you $500, but now you're not earning the income on the $500. So now you have to say, well, you're buying the TV for $500, but it's going to cost you $560 because you gave up income you otherwise would have had. And the sad thing is it's income per year. So you're like, well, I'm going to keep this TV for let's say 10 years. So this $500 TV is actually going to cost you $1,375. And you're like, $1,375? That TV is not worth $1,375. Then don't buy a TV, bro. Keep your money invested. If you have to, lease the TV for $35 a month from a rental company. Maybe that's even better. I was doing financial analysis of Porsche. Porsche has a deal for $3,500 a month. You get $1 million in Porsches. In cars. That's a lot of Porsches. I think it's 7 or 8 Porsches. Now, they keep them in the garage for you. They change the oil for you. They do the brakes for you. They deliver it to your house. You can have any Porsche you want. You're like, hey, man, I got a business meeting. I want a Panamera. Give it to me. And they bring it to your house. And then you're like, after the business meeting, you want to go on a road trip with the family and the kids. Hey, man, send me a Cayenne. So they bring a Cayenne to your house and take your Panamera away. Then you get back and you're like, you know what? Send me a 911. Cool. Anyway, so they bring a 911 and take the Cayenne away. It's kind of cool, right? Well, with low interest rates, if you borrowed $1 million to buy a house, you would need $200,000 down. Okay, and for $1 million, a mortgage used to be $5,000. I think the mortgage now on $1 million house, I don't know what but I bet you it's more like $7,500. Okay, plus you got to give up $200,000 for $1 million house. I thought this was interesting. If you do the math, I'm not counting insurance and all that kind of stuff, which is included. I think this is interesting. So Porsche gets cheap money from somewhere. And for $3,500 a month, which is, let's say, nearly half price, you get $1 million worth of Porsches. But here's the thing. To get the $1 million house, you'd have to give up $200,000 in cash, which you're earning a return somewhere in the stock market, right? Now, you might argue, you're like, Wayne, well, your house in 20 years will be worth significantly more as an asset. Well, I'm just talking about the cost of the money, not the return on the asset. I'm not saying even if you used cash to buy $1 million worth of Porsches, it's probably a losing investment. Eventually, those cars are going to be nearly worthless, right? Not totally worthless, but nearly. So anyway, so I'm just saying, if you do the math, you're like, dude, that's actually cheap money. I think that's cool. All you have to do is put gas in your Porsches. For $3,500 a month, you get a private garage, a private mechanic, private delivery, all maintenance, all done, all the insurance paid for. You get 8 different Porsches, and the cost of your money is like 3% a year at a time when we have 9% inflation. Cheap. Just shows you that we're in a world where we're getting closer and closer to cars being a service and not a product. Kind of interesting, huh? Okay. Let's take a look at Biddy. And it's holding its own. This is doing quite well relative to non-farm payrolls. But this could change for Bitcoin. So what I said yesterday, if the NFP number was big, then Bitcoin would come down. Okay. Oh, codename, yeah, brings back the whole point of that conversation, really. So let me flesh that out. If you had $1 million and you were going to buy 8 Porsches, 7 Porsches, instead of that, you could invest the $1 million, and let's say you buy the stock market, and on average for the next 10 years, the stock market goes up 8% a year. So you're making $80,000 a year. But potentially more. Okay? But your Porsches only cost you $40,000 a year. Do you understand? You own 8 Porsches, don't have to pay for any maintenance, don't have to garage them. You just have to put gas in the tank, and you make $40,000 a year profit. Okay. I went to get an oil change for my Porsche. $650 for an oil change. You don't have to pay that with this deal. It's all paid for. A brake job's got to be $5,000. Don't have to pay for that. In fact, you don't even have to take it to the garage. They do it. You don't even waste time doing it. So, yeah, $1 million with the Porsches, and on average, you're going to make $40,000 a year because you put the $1 million in the market instead of $1 million into the Porsche bank account. Huh? Porsches are free. You spend money on a car? If you spend money on a car, you either got a sweet deal or you don't understand finance. You're going to be poor the rest of your life. I'm not going to tell you the next speech, but I want to ask how many people here. No, it's true. I can sign that deal right now. By the way, I'm not going to do the speech, but I want to know how many people have heard the speech of how to get a Lamborghini for free. I just showed you how you can get paid to drive a Porsche if you have $1 million. See, that's the thing. If you're poor, you don't have any money. And you don't have any money, you can't take any risk, you can't deploy capital, you'll always be poor. So you got to change it, right? You got to change the narrative somehow and find a way to stop getting poor. Now, you might say, well, Wayne, what that means is I need to become a Forex trader and start gambling like a degenerate. No. You need to act like a professional. You need to think rich and not act poor. And so you got to know these things. And no, it's not rich dad, poor dad nonsense. Okay? So when you become wealthy, you will never spend money. Why is it that wealthy people can't spend money or don't spend money? Why is it that wealthy people don't spend money? Anyone want to guess? They don't have any money. Look, they might have cash in the bank to pay their monthly expenses and have a little bit for a rainy day. But all the other money is deployed. They don't have money, they have capital. They're not frugal. Like I just said, if you buy a TV, you're standing there at Walmart. By the way, there's a big red flag. Okay? But you're standing there at Walmart and you can get a 75-inch 4K TV for $500. A wealthy person would look at that and say, that's going to cost me nearly $2,000 in future cash flow. A wealthy person looks at the TV. Here's the TV. Okay, 75-inch 4K. Okay, $500. So a poor person would walk through Walmart and say, "Oh, I have $500. I like TV. I want to buy it." And now they don't have any money. And they got a worthless asset. In 10 years, you'll have to give it away or throw it in a garbage dump. Okay? A wealthy person says $500. The present value of $500 is based on the cash flow, which is the $500 compounding at 8% per year. Okay? Over 1 plus the inflation rate, 0.08 currently, over 10 years. And the math is actually quite different. This will really illustrate it. The present value of, let me just say, I'm going to substitute this $500 times 8. I'm just going to say future value. Okay? The present value of that future value plus the future value plus the future value. Okay, this is sorry, I was doing this one wrong. This is 1, this is 2. The future value over 1, my mouse is so bad. 1 plus I to the 3. And then you got to keep doing this. 4, 5, 6, 7, 8, 9. Future value of the $500 compounding for 10 years over 1 plus I to the 10. Now there's another variable, the I. So you can say if you want to put inflation or if you want to put in interest rates. So, let's say 2.5, 3.5, 3, 2.5, blah, 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 whatever. You substitute that out. And a wealthy person does the math in their head. and they're like, this will cost me $1,675 in the future. Okay, the present value of future cash flows of $500. And they're like, it's too expensive. A poor person says, that's a beautiful TV. It'll look great in my apartment. I got $500 in my hand right now. I can buy it. And a wealthy person says, I can't afford it. I don't have that much cash. And even if I did, I would not buy this with it because it's not an asset. It's actually a liability. It'll suck up your time and it'll devalue to zero. So a wealthy person says, I can't afford it. I can't afford the TV at Walmart. And a poor person would say, I have $500. I want to buy it. You see the difference? It's a strange way of looking at things, isn't it? Now, Codeman says, well, if you buy a laptop and use it to become a programmer, then you're acquiring an asset, right? Well, the asset is the education. The cost of doing business is the investment. Okay? But nobody says, like Codeman, you could go to the library every day and use their computers to get your education and do it for free. Codeman, you could say, you could buy a $1,000 laptop, and it's an investment because you're investing your time now into getting education. So what you're saying is labor to the alpha. But what I'm also suggesting is, well, if you can find a way to rent this for $28 a month or $48 a month, whatever it be, and then invest the rest of the money by buying the stock market low. So let's say of that you save a little bit of money. So let's say you have $800 now in the stock market and you buy the stock market low, and over the next 5 years, okay, this $800 turns into $1,200. Assuming we're near the low, and in 5 years the stock market goes back up. Okay? 8% a year for 5 years. Let's just say it ends up being $1,200. Then you gave up $28 a month, but now you have $1,200. And by then you've got your degree. So your laptop made you money. You got paid to own a laptop. Well, that's not true, is it? You, instead of giving up $1,000, you found a way, okay, to make money, or at least get the laptop for free. You see what I mean? Income producing assets are what you want to own. This is why you don't have any cash. See, you had to give up the cash. Okay? And that's the big concept with money. The present value versus the future value discounted over time. So if you have cash in your hand, that's the present value of the cash. And if you spend it and buy a non-income producing asset, you converted, let's say, $1,000 into a TV that in 10 years will be worthless. So you converted your money from valuable to no value at all. You burned your money. It's the same way as, like, one example I give is you invite everybody to your house for a party. And at the peak, when everyone is there, you go outside and you're like, hey, everybody, come out back, come out in the backyard. I want to show you something. And all your friends come out and they have cocktails and stuff. They're like, what's he up to, man? And you take $1,000 and you put $1,001 bills into a fire pit. You put some gasoline on it and you light it on fire. I'm telling you, at your funeral, they'll still be talking about that. That was crazy. Do you remember that time you put $1,000 in a fire pit and set it on fire? I'll never forget that. That was crazy. There's actually some sort of return on investment there. You take $1,000 and you buy a TV. 10 years later, you throw it in the garbage. And by the way, it sucked 100,000 hours of your life and turned your brain into jelly. But nonetheless, you converted the present value of your cash into zero. How do you get rich doing that? You see my point? If you convert it into income producing assets, like let's just say you buy the stock market, and because you're a good Forex trader, you know when to buy and sell the stock market. And in 10 years, you'll have more money than you had before. If you spend it on a TV, you'll have no money. You'll still be broke. You see? So money, you don't have any. What you want is assets. Okay? Yeah. And the smarter you are with money, probably the richer you'll get, right? So anyways, we'll see where Bitcoin goes. The trend is currently up, but I'm wondering how the fundamentals will impact such a thing, okay, on the longer run. Oh, my. Look at my WTI. Oh, my God. I'll probably need to go soon because I need to trade, and WTI is, oh, my God. Yeah, beautiful. Beautiful. Oh, my God. That's going to be a good day. Let's take a look at the indices and see how things have gone. Take care. See you, Johnny. Dollar's still ripper strong. Again, that's what we talked about before the news. I'm really surprised, actually, by how Euro's holding up. Pound is the best, right? Bank of England. No, I don't want to do Dow. It's all the same thing. Analyze it yourself. You'll be fine. I'm a macro guy. Once you know the direction, like the probability of the direction based on quantitative analysis of macroeconomics, then the rest is just technicals. You can figure that out. I'm not going to make an announcement today, but there is a service that I'm going to start. I've already started it. I'm not going to tell you what it is yet, but there's going to be, I don't know what to call it. You can consider it an alert service, a trading alert service, a buy and sell signal service based on fundamental analysis. There's a little bit of technical in there, but the quantitative analysis of macroeconomics, the algo thinks, if you want to call it that, gathers all kinds of fundamental analysis. Many different inputs. Employment, inflation, GDP, which is growth, market sentiment, institutional trading, retail trading, and technical trends. And it's doing all this stuff. And it's going to say, you should buy these things, you should sell these things, and everything else you should stay neutral. What do you think of that? And by the way, it's pretty. But I'm not asking you to sign up. I don't want you to sign up. If you don't know, you don't know. Certain people know, wink, wink. But for everybody else, I'm just whetting your appetite. I might be able to tell you the next time we meet for non-farm payrolls, and I'll show you. But imagine you woke up in the morning, okay, and you logged in, and it's like, hey, man, these are the things that changed to the bullish side. These are the things that changed on the bearish side. Here's in great depth all the fundamental details. But just read this and it'll explain everything. So you're like, I don't know any of this. So like seasonality. If you pay money for a seasonality service, you will be able to cancel that because that's included. If you track GDP, unemployment, inflation, and all these data sets, and then put them into Excel spreadsheet and all that, you can stop. It does it all for you automatically. If you pay money or spend time researching commitment of traders reports, looking at retail positions and institutional positions and trying to, what does it mean? Does this mean I'm a bull or a bear? Have things changed? Are we a peak or a valley? What do I do? You can cancel all that. That's all included and interpreted for you. It gathers all the fundamental analysis of macroeconomics for 28 asset classes, including the Nikkei, the DAX, the Dow, the S&P 500, the FTSE, gold, oil, major pairs, cross pairs, organizes everything, and then translates things to plain English like, don't buy this, or you should consider selling this, and you should really, really consider buying this other thing. Huh? $50 a month, though. What do you think of that? So maybe I'll be able to tell you next month. But I just want to whet your appetite. What do you stink about that? Das gut, ja? Das gut? Okay. So maybe be here next month and you can sign up next month. But if you want it sooner, join FX Bootcamp because I'm only going to tell boot campers. Yeah. Sehr gut. Yeah. Oh yeah, it's redonkulous. It even will, not only will it tell you to buy or sell an asset, it'll do essentially standard deviation studies to say if that current trend continues, it'll project price out a week or more in advance, but not just on trend, but what if the trend increases or decreases? So it does the mean and the standard deviation above and below. So it gives you base case, worst case, best case if the trend continues. Projecting a week or two in advance of what the price will be in 3 or 4 or 5 days. Oh my God, you're kidding me. Not just the fundamentals. So it's doing that technically. But here's what's most important. Many of the times you're going to see, let's say based on quantitative analysis of macroeconomic data for euro dollar. because it's looking at interest rate differentials, like I said, growth rates, inflation rates, all these different things, institutional positioning. It's looking at a lot of things. Let's say based on, the quantitative analysis of this pair, including seasonality, euro dollar is expected to fall. Now, that's based on facts. There's no opinion. An algo, okay, doesn't have an opinion. It's looking at the facts and says, this should fall. But what if you open your charts and it's rising? Do you sell it? No, you'd be a fool if you listen to a computer. Because remember, the computer doesn't think. It gathers the information. It does the math for you. And in this case, puts out lots of really pretty colors so you can look at it as a human. Okay. And it says deep, red, strong sell. And here's all this stuff. And then all the rationale and reasoning. Okay. But it doesn't mean that that's happening now. It's just saying the math would suggest that this should fall. So then what you would do is you'd open your chart. And of course, there's a basic chart in there that might say, this is fundamentally a strong sell, but price is rising. So you should look at it and say, I want to sell it, but not today. Hey, Coco. Not today. Why? Because technically it's going up. So it actually looks at the technical trends and reduces the score in the algo. So it's like, well, you could sell it, but you shouldn't do it now because the trend is up in the technicals, but the fundamental trend is down. So what you would do is you'd wait and you'd wait. One of them is wrong. You understand? Maybe something fundamentally is about to change. Maybe the algo is gathering. I mean, look, a lot of fundamental stuff is kind of backward looking, right? What GDP was, what inflation was, what were jobs were. Like the COT data is basically a week late. So it's looking backward. It's not looking at things saying, well, the way the market interpreted, the Bank of England or the ECB meeting, right? It's not doing that. Although it's looking at sentiment, it's still backward looking kind of sentiment. It was sentiment last week and takes a bit, but technicals are built in. And so it can start scoring it. But look, the uptrend could be profit taking and the downtrend could be the trade. Or the actual new trend is up and the fundamentals haven't caught that because people are betting on the change. But what you could do is see there's lack of congruency between fundamentals and technicals, and you wait. So again, if euro dollar, it says short, 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 but not right now because the technicals are unaligned. Well, what an amazing opportunity if, like after a day like this, euro dollar goes from technically long, let's go back to this, to technically short, because you got to remember during this period, let's say all last week, it said fundamentally down, fundamentally down. Let me do this in black. Fundamentally down, fundamentally down, fundamentally down, fundamentally down, fundamentally down, fundamentally down. But it's going up. You don't sell that. But what if you start to get technicals like a lower high and then non-farm payrolls drops this? Then you're back now into a scenario that I have already drawn out where the fundamental trend is likely this way. And that's based on quantitative analysis comparing these two economies. And then all of a sudden you get a non-farm payrolls like this, and that's the catalyst that you needed. So you get lower low, lower high, lower low, lower high. And now you know a couple of things. Maybe there's trending opportunities for you to trade in the future based on technicals. Or maybe you sell soon. So like maybe your plan next week is sell and right, but you hold not for an hour, not for 4 hours, not for 1 day, not for 1 week, but maybe several months, maybe 1 quarter. Because now you've lined up technical analysis with fundamental analysis, deep, complex fundamental analysis explained in simple English, really. And remember, I said news is not fundamentals. News is not fundamental analysis. Okay? The long-term trend of many pieces of news, the trend in many pieces of news, aggregated together becomes analysis of fundamentals. But you might have to look at, let's say, at least a deep dive in 9 variables. Okay, the aggregate, the sum of at least 9 variables. And then comparative analysis of each over 28 different asset classes. So you'd have to do like dollar versus gold, euro versus gold or something, or in stock markets and all these different things. And what you do is you start with the fundamentals, get your bias set, and I explained, bias is not opinion. Bias is the what did I say? Not the results, the interpretation of facts. No, your interpretation might be wrong. So, and you might not have enough facts. So why not have a quant work for you to gather all the statistical analysis of all 28, right, assets, and then break them down into 9 components gathered by actual economic data, and from that make an interpretation so it tells you buy S&P 500. And then you open up S&P 500 and it's down, and you're like, well, maybe not today. Okay? Or what it does is say, yesterday it said, let's say, buy S&P, let's say it said strong buy for S&P 500 because all the economic data suggested that up. I'm just saying, let's say that was the scenario. All the fundamental data was there, including an uptrend. But then today, the uptrend, right? So when you look at the trend component, the trend went from up to, let's say, down. So what would change today and tomorrow? It would probably say, oh, well, the trend is now down, and that would reduce this from a strong buy to a buy, and that you should wait for the trend to turn back up. And when it does, the other fundamentals probably haven't changed that much. And then in that case, it would turn to a strong buy again. And it's alerting to you. Take a look, okay? Or instead, the trend drops, okay? So we got to get rid of this now. And that lowers it to a buy. But then when the rest of the fundies, so let's say unemployment rises, inflation rises, interest rates rise. Well, then it's going to say, oh, dude, it's going to go to neutral and then eventually sell and then maybe strong sell. Because now the fundies are getting worse and worse and worse, and the technical trend is down, and it's updating you. It's helping you look at how to make these type of decisions. Is right? You see where I'm going? This is how I've been teaching people to trade for 20 years. You still have to know how to trade. You'd be a fool to take the advice from an algo because the algo can't think. But you should be able to use it as a guide to organize your thoughts, organize your trading. Which assets should you be looking at? Which of the assets should you ignore? Imagine if all it did was say, ignore, okay, these 20 assets. Just ignore them. Oh, the trend might be up, the trend might be down. Ignore it. Just ignore it. Don't even look at it. It's not worth your time. It doesn't exist. You're going to get caught in sideways. You're going to get weird volatility. It's not going to work the way you think. Even though you see the prices going up, it's not a good investment opportunity to buy. Like, just ignore it. Let it go. It's noise. It's a distraction. Don't look at those 20 assets. But there are 3 very interesting buy opportunities, or 5 very interesting buy opportunities, and 3 very interesting sell opportunities. So ignore all this crap and take a look at this stuff. Go read it. There's literally a written description of what all it means. So if you're like, Wayne, I don't have a macroeconomics degree, all this stuff is gobbledygook. Well, it'll explain it in English, but it's really simple. Really simple. It'll explain it. You're like, oh, okay, I think I understand that. And then you go and check out these assets and see if technically there's a buying opportunity and see if technically there's a selling opportunity. And it'll kind of actually, in the analysis, it actually shows you if there is or not. Okay, so for example, if it says there's 5 opportunities for buying, so you go to one of the buying opportunities, but it says the trend is -2 under trend, well, that means currently there's a downtrend. So you're like, oh, and you just go on to the next buying opportunity. And when this goes from -2 to +1, now you should really seriously think about getting involved because all the fundamentals say up, but now it technically, the trend is now up again. Boom. Boom. But you know what? Honestly, I've been teaching for 20 years to trade this way. And it's, let's just say it's difficult. It's hard to do all that kind of stuff. It's very difficult. Just to get the information takes a lot of work. Well, now you'll have it in like 4 minutes. Okay. Okay. Takes 20 years to get there. I do the same thing on my own, always have. Before developing the tool, I've always done this, where I can say, well, based on my fundamental analysis of macroeconomic data, this is what I think. And I took you on a journey today, and I hope you appreciated it, by the way. I took you through the journey of ISM, weekly jobless claims, Challenger, Christmas, and Gray. Okay, the Fed tool, the trend in NFP. We went through all of this. And I said, the experts are wrong. I want you to think about that. Honestly, think about it. The experts are wrong. How much internal fortitude do you think that takes? You might think I'm an arrogant son of a biatch. But what I want you to really think about is I did this work long ago, but I did it with you today. We did this in what, a half an hour? And very easily concluded the experts are wrong. Do you know why? They're not that good. You're relying on people that do extremely mediocre work. Some journalist major at the Wall Street Journal said 260,000. And you're listening, you're taking investment advice from a journalist major that makes $38,000 a year. If you're a Forex trader and you can do the work yourself and you're like, that's crazy. It's going to be way more. Now, I didn't say 500, but I can't tell. I can tell that this was wrong. And we said a lot higher. Okay? So if you know how to trade, right, you'll make 380 to 3.8 mem a year. 380K to 3.8 million. The only difference is your assets under management. But the thing is, you don't take advice from anyone, especially a guru on YouTube. You're joking. I know you're on YouTube right now taking advice from me. Well, that's ironic. But I want you to think about it. If you're taking macroeconomic decision making from a journalist major, even if they work at the Wall Street Journal, it's really not advisable. And if you're listening to a kid on YouTube tell you how to get rich quick, I taught you about the real value of money. There's no such thing as get rich quick. Do you understand? The only way to get rich quick is robbing a bank or winning the lottery. And either way, you're going to have negative outcomes because you still don't understand money. Master's like, yeah, authentic tested by time. Yeah, how many YouTube gurus have been trading for 20 years? Geez, the average age is probably 23. Okay. Master Trader says seriously longest. Well, there's lots. There's quite. I don't know if there's lots. There are experts on FXStreet that have been doing analysis with FXStreet since the beginning of FXStreet. Okay. So, I'm not the only one. I'm not the oldest. But I've known many of them for, like I said, decades. Okay? Like Joseph Trezevani, I've had dinner with a few times, once in Spain and once in New York. But I'm talking about like 2007, 2008. He worked at a broker called FX Solutions. And I knew some of the guys on his team. They're good people too. And he's got amazing stories and he does great work and he has a solid understanding of fundamentals. So I can't say I'm the best and I'm the oldest and all that. But there are very few that have been around that long. Okay. Ed Ponzi would be another one. I believe he still does stuff at FXStreet. So he's been around, for the full history of FXStreet. So there's good guys out there. And gals, I'm sure. But it's when you log into YouTube and there's a kid scalping with big lot sizes and he wants to get yellow Lamborghinis. Fool's errand. Okay. So be careful. I care. In that sense, I care. I want you to succeed. I'm trying to give you good advice. I know 99% of you won't listen to a word I say. In one ear and out the out next. I get it, but it's just part of how it goes. Okay? Oh, thank you, FXStreet. And moderator, you work with Joseph Trezevani still, is that right? I think so. JT's good too. Yeah. Yeah. Cool. So one of the things I preach as well, and J-Man says, take your time. That kind of makes me think about this. Like, look at the euro dollar. We're so interested, like, look at an NFP. Oh, I got to get a trade. Let's scalp it. How many NFPs do you see here? Oh my God, we got to trade. We got to trade. Get in the trade. Oh, you missed it. Oh, you missed it. No, get in now. Oh, there's a counter trend. Oh my God, look at this. Oh my God, Bria. How many non-farm payrolls do you see here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. And now we're setting up 15. Do you understand? Fundamental analysis has to do with logic and facts. So that what I preach to you is important to to many different types of traders. One would be you feel like the market is random. I can fix you. The second thing is, what if you don't have a lot of time? What if you have a day job? What if you have 5 kids, 3 wives, 2 cats, and a guinea pig? And you're like, I don't have a lot of time, but I want to be a Forex trader. You should be a fundamentally based swing and position trader. Okay? So, for example, every Thursday at 4 p.m., we plan next week's trades. So what I did yesterday was plan the euro dollar short, the pound dollar short. Oh, cool. Nice. And those trades should last between, 1 and 5 weeks. Now, to actually enter the trades, sometimes they happen on a Thursday or Friday. We call that a Friday front run. Friday front runs are great. So that's why we meet on Thursday to plan trades you should already be in by Monday. If you show up on Monday and you're like, what's going on, fellas? What are we trading? You are not going to be successful. You're going to be reactionary. You're going to be my liquidity event. When I take profit, it's probably you taking the trade from me, and you transfer your wealth to me, and then good luck. I hope the trade works for you. I'm out. Okay? So that's all planned days in advance, and we like to stay in for a while. So we'll say somewhere between 100 and 300 pips minimum. And we like to compound those over time. So, okay. But another way of doing this is you take the fundamental bias in the technical trades. And yes, this is swing trading. But in my day trading group, we meet Sundays. Yeah. Sundays at 7 p.m. for the pre-Asia Open. Why? Because we're front running the London boys. We already know what we want to do. We already know if we're bulls or bears. So we're going to front run the London boys. Probably execute what we planned on Thursday. So it comes down to like, if you only have an hour or so a day, or even an hour a week, you can be a fundamental trader. By the way, the traders that trade for hours at a time on a 5-minute chart and a 15-minute chart, I don't think the majority of them are profitable. In fact, I think the vast majority are very, very unprofitable. And I would venture to guess if you became a fundamental biased trader and you only had a couple of hours a week to trade, if you know when to trade and how to trade and why you're trading, there's actually decisions behind your positions, then I think you could take advantage of this trend, couldn't you? The one that lasts years? Don't you stink? Let me try to convince you. I'm going to change the chart here. Let's say you had a fundamental bias. The analysis, okay? The analysis that you conducted fundamentally said you should be a bear on euro dollar. Cool. Let's take a look if we can simplify this now. Okay, I have something called position trading bearish bias. Okay, let's take a look. Okay, all right. So what this says is sell in the pink zone and take profit at the aggressive targets. Or let it run. How many people have enough time to pay attention to that? This is a sell zone. 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 Notice technically we get caught in a range, but eventually break out. This is a sell zone. Okay. This is a sell zone. This is a sell zone. This is a sell zone. And we're now currently in a sell zone. And you don't have enough time to trade because it takes 6 hours a day? Really? J-Man says, do I cover gold in the swing trading group? I can. You just have to ask. Or you use this information to create a technical and fundamental bias. And then you can refine by actually spending a little more time. Okay. But imagine you see this is already trying to calculate September. This sell zone that we see here for August, we've known for weeks. I want you to think about that. Really, think about this. This is important. We already knew that July was supposed to fall in June. So it fell in June. So here we are in the middle of June. And it says, let it come up to around 106 and then sell it. So it went to 106 and then it fell. Here we are in the middle of July. And it says this should come up to 103 and you should sell it. And right now, I mean, we're the first week of August, and we're already trying to calculate the sell zone for September. It's just obviously too early to enter a September trade. But imagine since about the middle of July, let's say around July 15th, which is about here, you already knew a pullback would be this way. And that maybe you should set up already for the next sell. We don't know if it's right, but that's what it is. Also, notice that my algorithm here says exit right there. And you knew that at the end of June, it said sell at 106 and exit whatever that number is, 101, 500 pips on euro dollar. And you knew that in June that your sell zone would be around 106. You should take profit at 101 and then walk away and let the next one set up. And now you might be in your sell zone. And maybe we're on our way down. Now, we don't know if it's true, but that's what technical analysis would tell you. And it's telling you sell it at 102, go for 97. So the plan for August, which we knew 2 weeks ago, is that. Well, will that work? I don't know. But I'm telling you, the fundamentals say it's possible, and the technicals say that's what the statistical analysis of price and time would lead you to. We don't know if it's true. It's just math. So, for example, if I measure from here to here, it's just math. It doesn't say it's going to continue, but what it says is y is equal to mx plus b. So it's creating a y and x axis of the data set we're measuring. So there's the y and the x. It's calculating m, which is slope, which is the negative rise. Okay, the negative rise over the run. So that's your slope. And b is where we intercept the x and y axes. Okay, and then it's taking the variance, which is telling you it goes from here, then it goes from here, then it goes from here, and then it goes from here, over here, and over here, and here. It's looking at the variance and then taking the square root of the variance and creating the standard deviation. It's not predicting the future. And the fundamentals are suggesting down, but it doesn't say the war in the Ukraine is going to get better, the war in the Ukraine is going to get worse. There's going to be a nat gas problem. There's not going to be a nat gas problem. Germans are going to have a warm winter. Germans are going to freeze to death, and we will have a death count every single day on the news. It doesn't know any of that. But it's just saying, based on the trend in fundamentals and the trend in technicals, we should be down here sometime in August. It could go that way. And everybody else just makes it up as they go, reacting to what's happening. I think it's going to go up. I think it's going to go down. Nobody cares about your thoughts. I don't think. I want you to understand that. I don't have an opinion. I analyzed the data technically and fundamentally, and I've come to the conclusion of what the facts say. There's no opinion. I have data and facts, and they add up to a conclusion. Non-farm payrolls is going to be a big number. The experts are wrong because they didn't do the level of work that I did. My conclusion was better. And that's the value creation that we need to do. Okay? A 22-year-old journalist major working at Bloomberg comes up with a number that says 260. I can out-hustle and outsmart that person. Not because I'm smarter. Maybe I am. But because I did the work. I did better work. I have more experience to do the work properly and make the right conclusion from having better facts and more facts. And that's why a Forex trader makes more in 1 month than a journalist major makes in a year. Maybe more money in one, week than a journalist makes all year. Because more value is created. You might make smarter decisions, and the rest is trading properly with assets under management. So how do you get more assets under management? A track record of conservative and consistent trading with a fundamental bias behind it. So you can sit down with an institution or a person with lots of money that doesn't have a good understanding of the future, and they need your help. Wayne, please help me. We have money. We're worried about risk. We see all this stuff on TV. We're extremely concerned. Can you help us can you protect us from potential future risk? We would gladly pay you. Could you please explain the next 6 to 12 to 18 months of what could happen? What are the probabilities of these things? And then have strategies developed to protect us. Help us, please help us. If your answer is yes, I have the data. Let me show you the data. Let me explain what the data means. Let's come to some sort of conclusion about the probability and how that would positively or negatively impact your money, and develop strategies to protect your wealth moving forward. And by the way, I want 2% management fee and 20% of the returns I produce for you. And they might say yes. And that yellow Lambo is imminent. Why? Because you found a way to make a lot of money quick? That's a fool's errand, and it's a story of poverty. But if you say, I can create value, if you can create value, and you tell somebody, for every dollar I create for you, you will pay me 20 cents. You have a viable business model. A sustainable business model based on value creation. How do you create the value? You can predict the future. How do you predict the future? You can do the work yourself, get the data and facts yourself, analyze the facts and data yourself, make a wise conclusion of what the facts and data mean, and carry it out through trading on behalf of other people. And if you want to think about it, that's how you get filthy, stinking rich. But the thing is, to even think that way, I think, is a detriment. Probably will hold you back. I think you should love what you do, be passionate about doing it every day without fail, kind of like doing a webinar every single month for 16 and a half years without fail. That's kind of the consistency that people like. And then you want to share that value with others. That passion, that love, that hard work, you want to share it. I think that's the success you're looking for. And then you will do it every day without fail for years and years, decades and decades. And if you go on vacation, you still do the work. If you travel to the other side of the planet, you still do your work. Why? Because you have to? Sorta. But because you love it? Especially. So thank you to FX Street for hosting for the 96th, 97th time. Great. If I created some value for you today for free, click the like button and maybe tell FX Street. Maybe leave a comment and say, oh my God, that was awesome. And tell FX Street that we should continue all the way to 200, maybe even more. So let FX Street know this was great. Please visit FXBootcamp.com and become a member. I might be able to help you. It's $88 a year, bro. I would like you to visit tradersway.com, open up a demo account. You'll find they're faster than most brokers. The spreads are competitive. The swaps are much better than most. But again, a business model based on ethics. And if you become a client to Traders Way, you can hang with me every single day. Peace on earth. May the pips be with you. May your profits be above average. Please have a wonderful weekend. Thank you for your time. Cheers.